See, now, emerging markets, are they too richly valued? Brazilian stocks are up 37% this year, but recently there has been a sell-off. Let's find out why, and let's also find out what lower interest rates in Brazil have to do with stock market there. My guest, Citigroup strategist Geoffrey Dennis. Geoffrey, good to have you with us.
Nice
Thank you very much for joining us. Just give us a little bit of an overview right now. As I said, 37% increase in the Brazilian stock market. Put it into some context. Give us those records that we like to know
Well,
about.
we've had a fantastic run in Latin America. Latin America's increased by over 70% from the beginning of March, when global markets bottomed out, until the beginning of June, when we peaked, and we've gone sideways to slightly down subsequent to that. So that was one of the strongest sustained rallies we've ever had in Latin America. So I think the fact that we've seen a pause here in June and a bit of a pullback is very healthy. It's a consolidation process. Also, the second quarter just ending, when we get the numbers tonight, is probably going to have been the second best quarter ever for Latin America since the region opened up to foreign investors in 1990. So I really do think you've put some big numbers in place here, and if we get a pause as we consolidate, I think that's only very healthy.
All right, now you said the second best quarter ever for investments in Latin America.
Yeah.
I want to get more specific with you because I know that you spend a lot of time. You said you've been into Brazil, what, five times so far this year?
Yeah.
What is going on in Brazil vis-a-vis interest rates? Because every time I read a note that you put together, interest rates in Brazil always crucial to where the money's going.
I'm very old-fashioned when it comes to strategy. I think interest rates, the cost of money and the cost of capital are tremendously important. And it's actually, to be fair, not just Brazil. You've seen, because these countries in recent years have produced really good monetary policy, and they raised rates aggressively last year to deal with the commodity price spike that we had. They've all been able to bring interest rates down aggressively this year as these economies have slowed. So Brazil now has got short-term rates at 9.25%, the first time since the 1960s that rates have been in single digits, and that's very powerful support for the equity market going forward.
And also inflation, right? Because usually when you talk about interest rates, and particularly in Latin America, the next shoe is you say, oh, okay, well, tell me what inflation is doing there.
And it's a very fair comment, because in fact real rates in Brazil for a long time were around the 10% level, even earlier in this decade. So given that inflation in Brazil right now is just below 5%, we've dropped real rates to 5% basically now, which is a sign of confidence amongst investors about monetary policy, a sign of the maturation, if you like, of the anti-inflation strategy the central bank has been using. And our theme, which we put out in a report earlier this week, is that the sustained drop in the cost of capital will, over time, bring more and more money into the equity market. Because for so many years in Brazil, investors have simply invested in fixed income, put their money on the street, and earned a large return. Now, as rates come down, it's becoming harder to do that, and that's why some of that money is going to flow into equities over time.
Well, because, I mean, the argument always was, well, if you could get 10% or more in a government bond, why even take the risk of going into the stock market?
And if I may say so, and the rest for a period of time, well over 10%, 15, 20%, and you could bank that pretty easily and then just really relax and not risk losing it. Now we're in a situation where with rates that much lower, I mean, it's obviously more complicated than that. You've got to be confident about the earnings story. You've got to be confident about
Well, that's where I was going to go next, because let's talk about earnings right now. What are you projecting for earnings? Are we going to see any kind of slowdown in earnings in the Brazilian market?
It depends the way you look at it. Calendar 09 is going to be a tough year for Brazil on earnings. We reckon earnings are going to be down by between 25 and 30% in dollar terms. Now, before we start worrying what that might mean, just think about commodity prices. Brazil is a market where 55% of the market is basically energy plus materials. And this is, 08 was a very high commodity price year. Oil prices, for example, averaged $100 last year. So unless we get an enormous further spike from here, commodities in 09 are going to be lower than they were in 08. And that drives a fair amount of this decline in earnings. But the bottom line is we think the momentum of earnings now, as we head towards mid-year, is beginning to bottom out, and that's also positive for the market.
All right, we're going to talk about some of those positive areas of the market more with Geoff Dennis. We're going to find out where he'll be putting some new money in Latin America, investment opportunities such as Peru, Mexico. We'll find out. This is Taking Stock on Bloomberg.
If you look past the crisis today and you say, where are the opportunities? Where's the growth going to be? Where are the demographic drivers going to be that haven't been changed by the financial crisis? You see growth in emerging markets, and so we want to deploy our capital to catch that growth.
The Chief Investment Officer of California Public Employees Retirement System, that's the biggest U.S. public pension plan, saying he's putting his money to work in emerging markets. That's our theme today. Now, this is Taking Stock. I'm Pim Fox. My guest is Citigroup strategist Geoffrey Dennis. Jeff, let's look at just some other markets on a larger scheme right now. I know we focused on Brazil, but what about things like Peru, about Chile? I know you follow those as well.
We like Peru a lot because it's a very well-run economy, very small market, of course, but it's very leveraged to the global economy. It's got a very big metals and mining sector. There's also
Southern Copper, right?
Yeah,
PCU.
That's correct. It's also got a bank that we really like a lot, Credit Corp, which is the leading bank in Peru, one of the best ways to play the financial system in our view. So it's probably of the economies that we follow in Latin America, going to be the one that holds up the best in 2009 in terms of growth performance. Chile has been badly hit in terms of its economy by initially, of course, the collapse in the price of copper, although copper's rallied sharply, and the fact that it's a fairly open economy with a lot of trade with Asia, and of course the Asian economies have slowed down. But because of the money they effectively have stashed away in Chile in their stabilization fund, they'll be able to use that to boost the economy, plus inflation coming down. They've taken rates, wait for it, to below 1% in Chile, and this is an emerging market. So they've had all the monetary and fiscal levers they've needed to support the economy, and I think that economy is going to come back pretty nicely in the second half of the year. Of course, it's classically a defensive market, a lower beta market, so it's not one of our favorites right now because we're positioned for markets to go stronger again later in the year.
All right, stronger markets. Well, let's talk about Brazil in detail. Which industry groups do you think are going to profit? I mean, we were talking off camera about those that might take advantage of lower interest rates.
Well, we're certainly overweight the banks. We like the financials generally. I think you have to be in the banks given that you had a big, nasty credit crunch, but for a very short period of time. And one of the themes at our conference in Brazil last week was actually credit growth beginning to resume, obviously at these single-digit rates. We're beginning to warm it to real estate. Real estate's had a very big move, and I'm not sure we really predicted it so soon. But we're beginning to like real estate. You have to like it for the long term, given what the economy is going to do.
Competitive market, though?
It is a very competitive market, and the stocks are not cheap. But we do believe that Brazil, which is a relatively poor economy, which is experiencing low nominal interest rates for the first time in living memory, you will see credit growth and you will see mortgage growth. And so it's a sector that I think you have to be in. And right now, we prefer steel to mining.
Why is that?
Because we're beginning to see, according to our analysts, we're beginning to see a nice pickup at the margin of global steel prices, which are the beginnings of some pickup. Now, obviously, we've had some of the restocking phase with respect in particular to China, but there's a bit of a demand pickup going on as well, and the steel stocks have become very depressed. And so, whereas on the iron ore side, for example, we're seeing a certain sluggishness of demand right now. With steel, our favorite pick there is Usiminas, the local, maybe locally driven steel company. We think that's a sector you want to be in.
And this was just a recent change that you made, right, in your recent report.
That's correct.
Usiminas.
Yeah, and basically, the cyclicals are going to come and go to a certain extent. But if the global economy really is recovering here, which is our view over the medium to long term, we think you'll do very well in some of these interest-sensitive domestic plays in Brazil, such as banks and such as real estate. And
how about the consumer sector, though? Consumer discretionary, whether it be in retail or maybe even in telecoms, for example.
The retail has got very expensive, and I think we would wait to see some better valuations there, maybe earnings to catch up a little bit. And also the staples are more defensive. Telecoms are a very defensive sector, so we don't think you need to be overweight in that sector right now. Our basic view here, Pim, is that you're going to see markets trade sideways for a period of time, consolidate. But the most important thing is investors should begin to prepare for another breakout later in the year, probably later in the summer. As we get confirmation the Brazilian economy is growing again, the U.S. economy in the third quarter is probably going to start growing again. And that's going to get people excited about equity markets worldwide. And I think Brazil is going to be a big contributor to that.
Is there a specific catalyst, though, when you take a look at Brazil? I mean, because in the past appearances, we talked about re-rating of Brazil's sovereign debt. That was a catalyst. But are there anything specific that investors should point to?
I don't think there's a tipping point.
Just generally look at the economic performance.
We do expect the second quarter to show growth in Brazil, positive growth. I think when we get confirmation of that, that'll be a trigger. We also think that given the market's somewhat expensive compared to earnings, we'd like to see confirmation the earnings have bottomed out. Those could be triggers. But I don't really see one individual tipping point at a given time. I just think markets will trade sideways for a bit, and then we'll break out to the upside. And there's a lot more money to be made in Brazil over the long term. term.
What about making money in a place like Mexico? We're going to talk about Mexican housing, but I mean,
Mexico, I think there's nothing wrong with Mexico in the long term. I think it's dealing with a very deep recession. We're looking for GDP to contract by 6.2% this year, which is as bad as it was in '95, coming out of the devaluation, the so-called tequila crisis. And our issue with Mexico is I don't think we're through all the bad economic data yet. We haven't really seen the full effect of the swine flu outbreak earlier this quarter on the economy. So we think the economy in Mexico bottoms out at least 3 months, maybe 6 months after Brazil. So I think you've got time to wait there. But there's nothing wrong with the Mexican story long term. It will come back. It will hitch its wagon once again to the U.S. economy. And I think Mexico will do well again into 2010. But I think Brazil's going to be an earlier mover than Mexico.
What about energy in Latin America? I mean, we talked about the miners and steel. You prefer steel. You talked about the banks. But, you know, I bring it up because Mexico's got Pemex, a big government oil. If you want to invest in oil in Latin America, where you got to go? Petrobras, right?
Yes, absolutely. And we're actually underweight the energy sector right now because we think it's got a bit expensive. We suspect oil at 70 is a little bit on the rich side. So again, waiting for a pullback before we get more aggressive. But there's no question at all. You need more public investment, or more investment, preferably not public, in Pemex to really capitalize on their oil reserve that they have in the Gulf of Mexico. Output's been weak. It's a very inefficient company. You'd like to see it, some private capital get injected into that company, but it doesn't look very likely, to be honest. And energy, you're going to get that mainly in Brazil. They've got massive reserves, of course, in the Campos Basin, as I'm sure a lot of people know.
All right. I want to thank you very much, Jeff Dennis. Have a wonderful trip wherever you go in Latin America. Next, I want to thank you for coming in from Citigroup strategist Geoffrey.